Club has always been a forum for public figures, thought leaders, and decision makers to share their ideas. Here, we offer access to dynamic political, business, and public personalities.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Hello, and thank you for joining us. My name is Anita McCuitt, and I'm the immediate past president of the Canadian Club, Toronto. I'd like to begin by acknowledging the Indigenous peoples of all lands that we're on today. While we meet today on a virtual platform, I'd like to take a moment to acknowledge the importance of the land which we each call home here in Canada. We do this to reaffirm our commitment and responsibility in improving relationships between nations and to improving our own understanding of local Indigenous peoples and their cultures. We're grateful for the opportunity to be able to come together to learn on this land. Financial services, which are foundational to industry and in fact, all human activity, is going through the greatest upheaval since the invention of double entry bookkeeping in the Middle Ages. And at the root of this Great Reformation in financial markets are blockchains, which allow us to create entirely new asset classes, new business models, and governance systems for the digital age. And I don't know about you, but it doesn't matter how many times blockchains and cryptocurrencies are explained to me or how many articles I read, I've got to admit it's all still a bit fuzzy for me. And I suspect I'm not alone. We have over 700 people registered today, so we know that people are keen to learn more. And we're so lucky to hear from 4 blockchain leaders, I think we have 5 blockchain leaders who are blazing trails in blockchain and decentralized finance. And it's a truly international panel today. Before we hear from our speakers, here's some information on how to participate with us. If you find that your internet is slow, just try hitting the click here to switch stream button. The video quality may decrease, but the audio quality should remain strong. And we do want your questions today. So just click the questions tab, enter your question in the window, and they will be sent directly to our moderator. Canadian Club Toronto is able to make our events free to stream thanks to our sponsors. Our gold sponsor today is Wealthsimple, who with their support made it possible for today's event to be free. And as I mentioned, we've attracted a great crowd from around the world. Our event sponsor for today is EY. We appreciate both of their support for this important discussion. Now, to introduce our panel, we'll start with a short overview of the current climate from Alex Tapscott. Alex is the Managing Director of the Digital Assets Group at 9 Point Partners, which manages over $6 billion. 9 Point's flagship ETF is the world's first carbon neutral Bitcoin ETF. And he is a sought after speaker and advisor and is the co-author of the best-selling book, Blockchain Revolution. Alex will then moderate a panel with some of the best in blockchain. First, we've got Galia Benartzi, who's the co-founder of Bancor, the world's first open source protocol ensuring on-chain liquidity between any blockchain-based asset, and the inventor of the automated market maker, now a building block of decentralized finance, also known as DeFi. Galia joins us today from Tel Aviv. We have Sandeep Nailwal, who is an Indian entrepreneur, software developer, and co-founder of Polygon, a blockchain protocol that is ranked in the top 20 worldwide and has a fully diluted valuation of over $10 billion US. And Sandeep is joining us from India. And perhaps I think he might actually be in a moving vehicle, which may be a first for the Canadian Club. Sunny Aggarwal is the co-founder of Osmosis Labs, creator of the Osmosis Decentralized Exchange on the Cosmos blockchain network, which in only 9 months has grown to 600 million US in total value locked. Sunny previously was a core developer of the Cosmos blockchain for 4 years, and today, Cosmos is a $10 billion protocol that supports hundreds of digital assets and applications. And last but not least, we have Andrew Young, CEO of Layer 2, a DeFi investment firm. And he's also the co-founder of SX Network, a leading DeFi prediction market and blockchain platform with dozens of projects and applications being built on it. He also hosts a podcast called DeFi Decoded. With this group, we are definitely going to learn a lot today, so let's get started. Before we do that, as is our tradition, if you have a beverage nearby, I'll ask you to join me in a toast to our country, to Canada. Now, I'd like to turn the podium over to Alex. Over to you.
Well, thank you, Anita, for that wonderful introduction. I'm going to start with I would say a 30,000-foot overview of why blockchain matters so much, specifically to financial services. But I'm going to try and move through it as quickly as possible because this is an all-star panel. Every single person on this call is either a founder or leads, a billion or multi-billion-dollar organization. So, it's like having the CEOs of a bunch of tech unicorns, basically, and they happen to be doing it in one of the most exciting areas in finance and in technology today. So this is a very exciting time in financial markets, but also in general in human history. And that's because we're entering a new era of technological development, often referred to as the second digital age. So there are many new technologies that people talk about as being important for this new era, everything from machine learning to new sources of energy to technology in our bodies. But there's one technology in particular that's going to help to animate a lot of these new trends and is going to usher in, I think, some of the most profound changes. And it may be surprising to some of you to hear that it's the technology behind cryptocurrencies and other crypto assets like Bitcoin, and it's called blockchain. It's my view, after spending quite a bit of time in this industry as a writer, as a business builder, and as an investor, that this technology represents nothing short of the second era of the internet. So let me explain what I mean by that. When you use the internet today to send and move information, you're not sending an original, unique thing. You're sending a version or a copy. And generally speaking, that's okay, right? In fact, it's a good thing. If you send an email to someone, you can send the same email to someone else. If you post something on Twitter, it's available for all to see. So it's kind of like we have our own printing press for information. Except when it comes to things that have value, assets like money or stocks and bonds or titles and deeds or votes or artwork, being able to create copies is actually not such a great idea. So if you owe money to someone, it's important when they receive it that they know it's the only version, that you can't send the same exact $20 to someone else. Or if you sell a share of a company, that you can't sell the same share to someone else, and so on and so forth. So it's great to have a printing press for information. It's not so great to have a printing press for assets. And this is a very specific problem that computer scientists tried to resolve during the first era of the internet. It was called the double spend problem. How do you ensure that when you move something of value peer-to-peer, that you can't create another version, you don't leave behind a trail of digital breadcrumbs? And so even though the internet had a pretty profound impact on the world, we still, until recently, have had to rely on intermediaries, middlemen, who sit in the center of transactions and perform some important steps. They establish identity of buyers and sellers or senders and receivers. They create trust and they maintain records and they perform business logic. So that's, record keeping, contracting, processing, clearing, and so forth. Overall, they've done, a decent job, but they have some very severe limitations. They're centralized, which makes them vulnerable to hacking or to attack or to theft. They add cost and friction to transactions. They exclude big parts of the population. There are billions of people who have access to the internet but can't access financial services, for example. and they capture lots of data about individuals. And that's true not only of traditional middlemen like banks and brokerages and other financial services companies, but increasingly of the large technology conglomerates and social media companies that really are the most important centralized parties of the internet economy. And that's problematic for a couple of reasons. One, obviously, your data can end up in the wrong hands, and that's bad for your privacy and whatnot. And that's an important issue. But I think an arguably bigger issue is that individuals who create the value online through their contributions don't actually get to participate in it. That value is captured asymmetrically. So what if the internet was entering a new era, from an internet of information to an internet of value? Well, in 2008, 13 years ago, as of a couple of days ago, an anonymous person or persons named Satoshi Nakamoto created this thing called Bitcoin, or wrote a white paper on Bitcoin. And what Satoshi described in the paper was a form of digital cash, a way to move money peer-to-peer online without a third party. And the innovation behind Bitcoin is called a blockchain. Now, traditionally, banks and brokerages and other financial intermediaries maintain a ledger of transactions. Anita knows, she works at PwC. And this ledger acts as a trusted source of truth, right, about what has occurred. And what a blockchain is, in essence, is a distributed ledger. So the record of transactions in a network exists for all to see, where anybody can access it, read it, and interpret it, but where no single entity can alter it. The only way that any new addition gets added to the blockchain is through a combination of consensus, collaboration, and clever code. In other words, the whole network needs to agree. Now, what was interesting about Bitcoin was not this a brilliant design, though it is interesting. It's that it actually works in practice. And it's worked so well that it's set off a spark that has caught on like wildfire and really transformed how we think about what's possible in financial markets and in the economy. And Bitcoin is enormous in size. It's worth just taking a step back and considering that since 2008, 2009, it's grown to over $1 trillion in value. Put another way, it's worth more than every single Silicon Valley unicorn that has been created since that time combined. So all of the big companies that we hear about, Airbnb and Uber and whatnot, add them all up and it's still smaller than Bitcoin. So what is the opportunity here? Well, the financial industry today, to many looks like it moves quickly and smoothly, but really if you look beneath the surface, it's a lot more complicated than that. I think it actually looks more like this image. This is a picture of a Rube Goldberg machine. And basically, for those who don't know, it's an apparatus that performs a bunch of complicated steps, and in the end, it solves a simple problem, like it cracks an egg or closes a door. And this is basically the way the financial market works in a lot of respects. And this is true even when we think about digital innovation. So you tap your card on a card reader at Starbucks, and you might think the money is moving from you to the merchant, but it isn't. It's going through your bank, their bank, payments company, credit card company, risk check, maybe a foreign exchange if you're traveling like many of our panelists. And it doesn't take seconds, it takes minutes or seriously, it takes days to settle, and it costs the merchant the interchange. So a lot of innovation in financial markets today, what's commonly referred to as fintech, is really more like digital wallpaper. It is a sleek veneer, a new coat of paint on top of the old industry that creates a more welcoming and more convenient sort of user interface. But fundamentally, it's built on top of and around the existing financial infrastructure that in many respects is older than I am and all of our panelists. The infrastructure for interbank settlements, the SWIFT network, was developed in the 1970s. And that's true actually for quite a few financial systems. DeFi, what we're going to really dig into today, is different. Rather than a new coat of paint, it's reimagining the architecture of financial services. If Bitcoin enabled us to move value peer-to-peer using this token called called Bitcoin, then DeFi is enabling peer-to-peer models for basically everything the financial industry does. Moving value, storing value, accessing credit, getting access to growth capital, exchanging assets, getting access to insurance and offsetting risk, even analyzing and accounting the function of the big five is something that I think is going to change profoundly. DeFi is a relatively new, well, it's a very new industry, so you'd be excused for not knowing what this is, but it's probably one of the fastest growing industries ever. The total DeFi users has grown from a handful of people, quite literally, a couple of years ago, to over 3 million in total users. Another metric that's used often in DeFi is a thing called TVL. It's basically like, roughly speaking, bank deposits or assets under management. It's the money that's deployed in this new system. And the value of DeFi has grown from a few $100 million a couple of years ago to over $200 billion today. So what exactly is this, and how does it work? Well, very simply speaking, Bitcoin is a single purpose blockchain. It allows you to move Bitcoin between two people, right, without the need for a third party. What DeFi enabled and what new blockchain platforms have enabled is a thing called a smart contract, which is basically a way to put the language of a business agreement into code so that it can self-execute. So if you think about financial services, a lot of assets that we own in the economy, like stocks, they're basically contracts. When you own a share of a business, you own a piece of a common enterprise, you have certain contractual rights, you have the right to cash flows if that company pays a dividend, the right to vote on certain matters, and so forth. All of the business logic of assets like stocks are going to be smart contracts at some point. And that's true not just of financial assets, but of basically every single function of the economy. So this, by the way, this description of the Golden Nine is something that I've been working on for some time and have added and subtracted here and there. And it's going to appear in full once again in a new report that I'm writing with the Blockchain Research Institute, a company I co-founded along with 9 Point Partners. The focus today, very briefly though, before we get to our panel, is just on crypto assets. So a lot of people ask me, well, why do we need millions of cryptocurrencies? Why have many different kinds of currency? It seems sort of odd. And there are actually good reasons why you'd want to have small community-based currencies, but in general, the point is well taken. And I think the key thing here is that most digital assets are not designed to be currencies at all. They fall into one of 9 different categories. This is a taxonomy as well that I've been working on for some time. Not meant to be authoritative, by the way. And in many respects, certain assets overlap and they can fit in different pockets. So, but it's a useful way of thinking about the industry. So the first category are cryptocurrencies. So Bitcoin being the granddaddy of them all, $1 trillion plus in value. It's cash for the internet. It's used as digital gold by people like in Canada who invest in it directly or through ETFs like 9 Points ETF. And it's also a lifeline for many of the world's unbanked who maybe don't have access to financial services or a reliable store of value because their local currency is, hyperinflationary, for example. I think Bitcoin is kind of unrivaled in this role. And one of the things that's helped to, I think, increase awareness, if not price, has been just the sheer growth of institutional adoption, whether it's countries or companies. The second category are what I would describe as protocol tokens. So these are the base layer tokens of the platforms on top of which all these cool new applications in DeFi are being built. Tokens like Ether, for example, which is the native token of Ethereum. The more applications that get built on these platforms, the more useful and the more valuable these platforms become. And because the native token is often used to run those applications or to enable transactions, then the tokens can appreciate in value, which is why Ethereum, for example, has a market value of $500 billion, which is more than every single Canadian bank combined in terms of market value. I should add also, since this is a Canadian event, that Ethereum was founded by a group of people which included many Canadians, including its main founder, Vitalik Buterin. It's Canada's probably most successful thing that it's ever made. And I think most people don't really know that history. It's also a source of great growth in the industry. Protocol tokens, there was a thesis called the FAT protocol thesis, where basically, a lot of value accrues to the platforms that all these new applications are being built on. It's too early to tell whether or not that'll play out in the long run, but the evidence so far suggests that these things are attracting a lot of value. The third kind of token are governance tokens. These are the native tokens of the applications built on top. So Osmo, for example, the native token of the Osmosis decentralized exchange, which Sunny has created, runs on top of Cosmos, which is the protocol, right? And these governance tokens can increase significantly in value the more useful the application becomes. Now, what's interesting is that in a normal corporate environment, you'd have, a business that has shareholders, and those shareholders would have rights. What happens in the governance token is that the token holders who can earn their tokens by providing value to the platform get the say in how the money that that protocol earns is spent. It's sort of like everyone having a vote over a common wallet. And these common wallets have grown tremendously in size. For example, the largest treasury belonging to a DAO is the Uniswap treasury, which has over $9 billion in value. The fourth category are what's called non-fungible tokens, or NFTs. So today are common. So the basic idea is that Bitcoin and cash, they're fungible, meaning a Bitcoin can be traded for another Bitcoin, or a dollar bill can be traded for another dollar bill. Non-fungible tokens are unique or very rare, meaning that they can't easily be traded for some version of the same thing. And there are obvious applications and art, collectibles, and in-game assets and things like that. And that's where NFTs are seeing a lot of interest. But I think increasingly they're going to be the basis for our digital identities online. If you think about the most non-fungible asset, it's you. You can't be traded for someone else. And that's true of the things that make you who you are. Exchange tokens are like loyalty points on steroids that exist inside of centralized exchanges like Binance. They give users the ability to get access to special services, greater liquidity, discounts on fees, access to new investment opportunities, and so forth. And in some cases, in Binance's case, for example, they also serve a dual purpose of being the base layer for their own blockchain ecosystem. These are enormous, surprisingly enormous in size. Binance's BNB token has a market value that's double the market cap of the NASDAQ. Securities tokens. So I think everyone here is familiar with a security, financial asset, like a stock or a bond. Broadly speaking, these fall into sort of one of three different categories these days in the crypto space. One would be digitally native securities. There are some decentralized index funds, for example, where if you put money into the contract, it then goes out and invests in things on your behalf. I view that as a security, some don't. Synthetic securities, which basically give you price exposure to traditional assets. So there's a project called Mirror that allows you to get price exposure to Google and Tesla and things like that. You don't actually have the contractual rights of a shareholder, but you have price exposure, sort of like a derivative. And then the third would be legacy issued securities tokens. We have seen quite a few banks and other institutions creating their own tokens on the blockchain. They usually have a backup, so I'm not sure I would describe those exactly as securities tokens, but at least they're trying. And then number 7 would be stable coins. So stable coins are basically crypto assets that are pegged to an asset in the traditional world, like say the US dollar, almost always the US dollar. They broadly speaking fall into one of two categories: centralized stable coins, which are backed by reserves that sit inside of banks, hopefully. And the US government has created some new requirements for that. And then there are decentralized stable coins where typically the coin is collateralized by crypto assets, which are held in a contract, in a smart contract. And the supply is managed dynamically to ensure the peg. And there's some pretty high profile examples of that. Like MakerDAO has a stablecoin called DAI that has billions of dollars in circulating supply and does more daily volume than Venmo, right? So this is a big market, even on the decentralized end of the curve. Number 8 would be natural asset tokens. So these are tokens tied to assets in the real world. Really interesting project. Another one built on Cosmos is called the Regen Network, where basically they're creating a registry of carbon credits that allows someone who either has a project and is creating credits, or someone who's buying them, to know that when they've actually bought a credit, it's the one that they thought they bought and that it's retired on a blockchain, so everyone can trust it a little bit more. And then the final category are central bank digital currencies. So these are the much touted killer app of blockchain, but in reality, there are very few, if any, real world applications of CBDCs. The bull case on central bank digital currencies is that they would reduce friction, they would maybe broaden financial access because you don't have to have access to a bank account with a corp or commercial bank, and maybe they can improve the quality of monetary policy because you can do helicopter money, drop money into people's digital wallets for them to spend. The risks are that they would be a tool for mass surveillance, and that they would basically cut off the relationship between money and privacy. Cash is a way to spend money privately. If we eliminate cash, then we eliminate that right. So this is a new paradigm. And with every new paradigm, leaders of the old react with hostility. And that has been true, not just through the blockchain revolution, but through every period in human history. Whether it's a new technology or a new system of government or some other innovation, there's always someone from the old guard who fights it. And this is a quote I like adding that Jamie Dimon said, because the second half is, I personally think Bitcoin is worthless, but our clients disagree. And I think that for anybody who works in financial markets, the market is usually right. So where are we in our sort of journey here? Well, it depends on where you want to start, but let's assume that the first era of the digital age began maybe 30 years ago. I think that was the start of the chessboard. So the analogy is that the inventor of chess is gifted anything he wants as a reward, and he asks for some rice to feed his family. But he asks to be given in the following way: 1 grain on the first piece, 2 grains on the second piece, 4 grains on the third, 8 on the fourth, and so on. And his wish is granted because the king just doesn't do the math. But of course, 8 becomes 16, becomes 32, and so forth. So by halfway through the chessboard, it's more rice than the kingdom can produce in an entire year. And by the end of the chessboard, it's enough rice to cover the whole planet in 6 feet of rice. So I think right now we're right in the middle of the chessboard. The world has changed because of the exponential growth of computation and technology in really profound ways in the past 30 or so years. Just imagine what the next period is going to look like. That concludes my remarks. I'd like to thank you all for paying attention. And I'm so excited to be joined by this expert panel of people who are joining us from all over the world. So without further ado, let's get things started. So Sunny, you recently closed a big financing round for your project, Osmosis, and it is a decentralized exchange that's grown tremendously. Can you describe exactly what the drivers are of growth in DeFi? Why is it that projects are able to scale so quickly?
Yeah, I think, so yeah, I mean, there's a couple of things that get people excited about DeFi. I would say currently, most of DeFi is still really focused around the cryptocurrency industry. It feels like a little bit like insider baseball, where it's like, on a platform like Osmosis, like what we're building is this decentralized exchange software. But most of what's being traded on Osmosis currently is like different types of crypto assets, and like all these crypto assets range in the entire, everything Alex just talked about across all the different categories. But one of the reasons that the DeFi ecosystem has been growing is just people want access to these like new types of assets, and the DeFi, there are basically 2 places where you can get them. You can either go to these more centralized exchanges, which offer, we have things like Binance and Coinbase and things like that, or you go to, these on-chain ones. And the nice thing about these on-chain ones is you get, sort of more security. You don't have to give up custody of your assets. And in a lot of ways, the UX is just a lot easier to use. And what's really cool is then, while we're using DeFi, this like serving this like cryptocurrency market, what's happening is that the tooling and infrastructure is getting better and better to the point where like, more traditional finance industry will also be looking at like, oh, wow, look at the UX that's coming here. And we're going to start to see more and more like traditional finance stuff switch over to being like, coming into the DeFi industry, oftentimes maybe using, for example, like the security tokens that Alex mentioned, or, some maybe soon we'll even see like new companies and stuff decide to go crypto native completely. And so that's sort of where we're going to see the next like growth in DeFi.
Well, I think that's really interesting. And I want to ask Galia a question because Galia, we actually had you on DeFi Decoded, the podcast, not too long ago, and you've been very generous with your time. But you told us about how Bancor originated with a lot of research in the community currency space, which we think is very interesting. I mentioned the idea of that in my remarks. But one of the issues was liquidity. how do you ensure that you can create liquidity in all these different kinds of new emerging assets? Now, the invention of Bancor, which is widely used today in DeFi, is this thing called an AMM, or automated market maker. Can you describe sort of the genesis of that and how that has evolved and what it's being used for today?
Yeah, sure. So kind of in keeping with some of the internet evolution themes that you went over in your intro, my team and I, when we saw Bitcoin, essentially being internet entrepreneurs ourselves, we came from gaming and video and cross-platform application development on mobile. What we saw in Bitcoin was the first user-generated currency. Essentially, the first currency created, by users. We don't know who made Satoshi, who made Bitcoin, who Satoshi is, but as is common with internet paradigms or primitives, when you see one of something, you're pretty much certainly going to see hundreds of millions of that something over time. So you can look at the first user-generated video, or the first user-generated forum, or user-generated group. And today we have hundreds of millions of all those types of assets. And so when we saw Bitcoin and realized we were looking at the first user-generated currency or user-generated token, we felt that there would soon be hundreds of millions of them, and started building or thinking about the kind of apps and tooling, as Sunny mentioned, that would be needed in that multi-currency world. So we really began just making marketplaces, essentially like a turnkey marketplace generator for folks that would let them create their own currency within a marketplace for goods and services in their hometown or within an affinity group. You can think of this like creating a new country, right? And trying to join the UN. You've got a new country, you want to issue your own currency to do trade within your country. And before you know it, you need to import and export with other countries, because you're kind of not an economy in a vacuum. And so same goes for these community currencies. As soon as they get interesting, they actually need and want to start trading with other communities. And in the normal use case, that means kind of trading into their local fiat money, right? So if you have, let's say, a group for mothers in your local community that uses hearts, a custom currency that you generated for the group, and your neighborhood is in Canada, sooner or later, you're going to want to start trading those hearts that you've accumulated maybe through selling goods to your neighbors back into Canadian dollar to take to the supermarket and buy food, where they certainly don't accept hearts. They don't even accept Bitcoin. So of course, hearts is way down the line. And that's when we realized that all of these new currencies would face the same liquidity problem, which is how does a new and maybe small currency to begin with, how does it become interoperable with the existing economy? Much in the same way, early video that was being uploaded to the internet either was or wasn't compatible with a certain user's, PC or browser or a particular website. It's why YouTube was so successful by embedding the YouTube player, right? Universally sort of across sites, because videos could be interoperable no matter where they came from. And so that's how we backed into Bancor, which essentially was an algorithmic solution to this problem. How do you take any currency and sort of mathematically tell it what its exchange rate is vis-a-vis any other currency, and allow that system to be fully permissionless, meaning anyone can kind of upload a currency or a potential currency into the network.
Right. Well, it's and what we've seen in practice is that this actually works. That's the other thing I think is really interesting about Bitcoin, is that it worked. And what's interesting about the AMM as a way to drive liquidity in new assets has proven to be incredibly successful, right? And so that's the great thing about innovations. Some things remain toys forever, but a lot of these innovations have become incredibly useful in practice. Andrew, I want to switch the conversation a little bit, because I said at the outset that in my remarks that DeFi, if it works at scale, can create a more fair, more efficient, more transparent, and more trustworthy financial system. And I think that in general, we're part of the way there, but there's still some implementation challenges. And I'm actually getting some questions from the audience already about what those challenges might be. So One of them is that some of these blockchains have become victims of their own success, like Ethereum. Ethereum was the first general purpose blockchain that allowed us to launch and run applications that do different kinds of things. But because of its success, it has become costly to use, which sort of runs against the democratized nature of blockchains, right? The idea that, this is for everybody. If it costs $500 to do a transaction, then it's not really for everybody, is it? So that was something that you encountered when you were building SX, and you made a decision to look at some other technologies. Can you talk about some of the scaling challenges that exist for blockchain and how they're being overcome?
Yeah, for sure. I think Galia had a really good description of how we also think of blockchains as their kind of their own kind of countries and sort of central banks. There's been kind of three waves of blockchains in how we sort of think about the space. The first wave for smart contracts, the first wave was kind of Ethereum. And the second wave, which is kind of happening right now, is these blockchains that are designed for scalability. So like Solana, and Polygon, a number of different networks. And I think the next wave is really going to be kind of application specific blockchains. And it's actually great that we have Sunny online because Osmosis is a perfect example of that. So the way we kind of think about it is that each of these networks is going to build on top of each other. So Ethereum right now, like you said, the transaction costs of using Ethereum have grown by about 10,000x over the last 3 years. Transactions that used to cost 5 to 10 cents can easily cost $500 to $1,000. And so what's increasingly happening is, obviously Ethereum's trying to scale themselves, but what's increasingly happening is that there's new layer 2 networks that are building on top of Ethereum and leveraging their security, but allowing users to sort of migrate to more scalable networks. And Polygon's the perfect example of that. And what I think is the next wave as well is these application-specific blockchains are going to build either on top of things like Ethereum or building on things like Polygon. And they're going to be designed for specific use cases, whether that's AMMs like Osmosis or prediction markets with what we're doing with SX Network. And so I think overall the space is going to scale vertically.
That's a very interesting way of thinking about it. The challenge of scaling is one that is important. The other one is interoperability. I think the idea that we want to be able to, if this is going to really have a big impact on traditional financial markets, then we need to be able to move and trade assets peer-to-peer seamlessly, regardless of what the underlying technology stack looks like. And Sunny, that's sort of one of the main driving forces behind Cosmos, where you were a core developer for 4 years. So can you talk about the challenge of these silos, these sort of siloed blockchains, and how what are the technology solutions to try and overcome that? And if you can, try and extrapolate for our audience, like what does it look like? Right now we know that it's emerging, but what does it look like in a year or two's time? Like how do these things all connect to each other?
Mm-hmm. Yeah, so a couple of years ago, there was one blockchain where people could build on, which is Ethereum. And there was this thought that hey, okay, everything will just go on this one blockchain. And, what's really nice about the Ethereum blockchain is you get this high levels of composability there. And
I call this just describe the term composability for everyone.
Yeah, sure. So what composability means is that different applications on the Ethereum blockchain can interact very seamlessly with each other. You can have a lending protocol on one talk to a DEX decentralized exchange protocol, and you can make it so a user can click one button and it will do some sort of leverage loop or something where they'll borrow assets and sell them, or if you want to short or something like that. It makes it very seamless. And this works, I call this the empire model of blockchains, where, Ethereum is this sort of empire in the sense where, what I mean by that is you get high levels of economic integration without via high levels of like political integration. By put everything in one system, you know, you can standardize everything, you can do all this stuff. And it's like, okay, great, we have all, you know, high levels of composability and economic integration. I think sort of, you know, the biggest invention of humanity in the last 150 years is basically this notion that, hey, we can create a world with high levels of economic integration without high levels of political integration, where, you know, today free trade is the norm. And, you know, we have technologies like the internet. And one of the biggest ones is this a concept called containerization. Containerization is, you know, I'm not talking about like the computer science term. What containerization is if you ever go to a shipping port, you know, you'll notice that they have these like big shipping containers. And the thing is, all these shipping containers are standardized. There's like a ISO, International Standards Organization, that like standardizes these. And you go to any shipping port in the world, they know how to load and unload these containers. You go to any you know, shipping ship in the world, they know how to carry these containers. And by standardizing these, what we did was we were able to now send goods from any port in the world to any port in the world. And this is part, you know, this invention in the 1970s is sort of like revolutionized like global trade. And so bringing this back to blockchains, was our vision with Cosmos as well. We're like, hey, can we create some sort of standardized data format that will allow any two blockchains to talk to each other? So, you know, whether you're building on Ethereum or Polygon or using the Cosmos SDK framework or Substrate framework, there's all these, like, today what's happened is there's been an explosion in the types of ways you can start to build your blockchain. You can use the EVM or get all these things. But the idea is, can we make it so we can standardize the thing so that, you know, no matter what chain you're talking to, you know, we're able to now send tokens in between these blockchains easily. We're able to send data between these blockchains easily. Are we able to have an application on one blockchain call, you know, do something with an application on another blockchain easily via this like standardization process?
Well, I think that's so critical because, yeah, I mean, the internet has a common, you know, communicating language and allows different networks to connect to each other, right? So we don't think about being on one internet or the other internet. It's just the internet. And I know that Cosmos's vision is an internet of blockchains, where the idea of like, is it Ethereum, is it Cosmos, is it Bancor, is it Polygon, matters less because all of these things are interwoven together. So we've talked a little bit of some of the technical components of this. I'd like to make it more ask a question that I think our audience cares about, and this is for you, Galia, which is when does Wall Street or when does the traditional financial market start to feel the effect of DeFi, and is it a threat or an opportunity to the players that are in the space today?
I guess I would say that I'm sure that Wall Street and traditional finance around the world is already, you know, well aware of DeFi, very aware of Bitcoin. If you're not aware of Bitcoin, I don't think you're still in the game. We've heard from all the major institutions all around the world. Either, you know, you showed some of the older anti positions, some of the newer positions are very clearly pro, but most banks and financial institutions that we work with or come across are, you know, developing crypto and DeFi strategies of one sort or another. I think kind of one thing that's interesting maybe to share with the audience, I'm part of a DAO, a decentralized autonomous organization that's essentially like a VC, a decentralized VC. We're a venture fund. Everyone put in some crypto, and together we make some decisions about projects to invest in. We are now, and this, you know, started about a year and change ago. It's very active. We're now called the Boomer DAO in some context. So, and I say that lovingly. And it goes to show how fast things are moving. There are maybe 10 new models of DAOs that have come up since the one I'm a part of came to be. Ones that are even more decentralized, ones that allow members to co-invest alongside the DAO's investments. And it's just, a tiny example of how quickly things are moving and changing. And so I think if you're kind of still on the sidelines debating whether to go in, you're already behind. That doesn't mean, to be reckless or to go in without understanding, but I think it's very, very clear that these technologies are the future or are a big part of the future. And whether the existing infrastructure sees the next as threat. If we take any page from history, the answer is always yes. The studios and music labels saw the internet as a threat, and it was very much a threat. And that said, many of the original kind of players or the older players managed to reinvent themselves in the new, whether it's presence in Spotify or deals that are more attuned to the needs of digital artists. And so I think there'll be a lot of creative destruction. A lot of the existing players will sort of, reinvent themselves or partner with the new players and the new technologies, and those that won't keep up.
Well, it's so funny you mentioned the Boomer DAO. I host a podcast with Andrew Young, and I'm the boomer on the podcast. In fact, there's in crypto, if you're in your 30s, you're like the old guard, which is, I think, another sign of how quickly things are going and how like the youthfulness of the industry. Now, I think it's inclusive. Everybody of all ages is involved in the industry. I'm not suggesting that's not the case, but the energy is undoubtedly very youthful. There's a couple questions that are coming in from the audience, which I want to address, and I'm going to try and weave in some of my own here. There's been a lot of talk of central bank digital currencies, and I'd like to just ask Galia, you first, and then Andrew, just for a 1 minute answer, like, what do you make of these things? Are they for real? Are they coming, or is that a lot of hype and no, meat?
So I'm calling in from Tel Aviv, Israel, where the Central Bank of Israel has made very clear that they're exploring the technology, that they're running pilots, in fact, on Ethereum. I don't think the question is, will central banks move to digital currencies? I think it's when and how. There's, if you double click on this issue, there's actually a fair amount of debate. What kind of currencies to issue, what kind of tech stack to issue them on, whether these currencies cannibalize existing fiat, whether they themselves are issued directly to the people or directly to the banks. I mean, there's a lot of granularity here. So again, I don't think the question is if, but when. It's sort of like asking, will corporations move to email? Yes, eventually they'll all move to email, some sooner, some later, some will have intranet, some will just use Gmail. But eventually they'll all kind of migrate to the newer technology because it's more efficient. Ultimately, it's also more secure. It doesn't mean that the solution doesn't present its own problems. It certainly does. With email, we got spam. We didn't have spam in snail mail. But then, every solution is the seed of the next problems to which solutions are then found. So.
Well, the idea of being spammed by a central bank is a scary thought, unless they're spamming me with money, in which case, bring it on.
It's called inflation.
Yeah, right. Exactly. Andrew, any thoughts on CBDCs? What are your views on that?
Yeah, I think Galia had a great response there. What I'm really interested with CBDCs is if they combine it with the elimination of cash. That's something that a lot of sort of politicians want to do because obviously cash is completely private. And the reason why that's interesting, or I guess scary, is if you combine a CBDC with the elimination of cash, governments can actually start charging negative interest rates and just essentially just take money out of people's accounts, which is something that a lot of sort of macro central bankers are excited by because you can stimulate the economy directly. But at the same time, it's kind of scary politically just because the idea that your assets could be degraded without you having any control sounds like kind of a dystopia in a way. Mm-hmm. And it's just kind of an interesting thing because obviously if you eliminate cash, then you can't sort of just you can't stuff cash underneath your sort of couch. You're sort of forced to have a negative interest rate. So yeah, I think that's going to be the sort of big question, is if they're combined with that.
Yeah, a variation of that I've heard is the idea of money that expires, which I think is another kind of scary thought. So, the government sends you a stimulus check, but you have to spend it before Black Friday. And that's a way for them to hit their, their numbers for the final quarter on GDP. And if you don't, the money disappears. So there's all sorts of, interesting and I would say also a bit troubling ideas that come about from the idea of a programmable money. So a couple questions from the audience, one that we get a lot at 9 Point. Do you think energy usage, specifically energy used to validate blockchain transactions, will be a barrier to adopting the technology in all aspects of society? For example, using blockchain to assist in transmitting health records. It's interesting if it takes a lot of energy, to send to someone's health records, maybe we'll do it another way. Sunny, you have an answer one in a few minutes. Do you want to take a crack at that?
Yeah, sure. So the energy use, I think when people are mostly like interested, talking about energy use in blockchain, I think it's usually in reference to like the proof of work system, which is this, it was the original consensus protocol that was designed for Bitcoin and was used on a number of blockchains, and it's still used today on like Ethereum and things like that. But since then, in the history of blockchains over the last 10 years, we basically developed like newer forms of consensus protocols that build upon the ideas that came from the earlier ones. And so, one of the biggest breakthroughs in the last 5-ish years is this development of proof of stake, which is a new way of doing building blockchains that avoids the like heavy electricity consumption of proof of work. And if you look today, basically every new blockchain that's launching today is using some form of proof of stake. And then even blockchains that originally launched with proof of work are trying to switch to proof of stake. So the main one would be Ethereum, right? So Ethereum launched as this proof of work chain, and it is currently in this multi-year process of switching to proof of stake, just because it's much easier to launch a new proof of stake blockchain than it is to change an existing one. Like it's kind of like trying to change the wheels on a car while the car is in motion. But basically what we are seeing is that like most of these blockchains are switching away from proof of work towards proof of stake, and that will like massively reduce the electricity consumption to the point where it's not that much different, not like in orders of magnitude higher than like the traditional data servers and stuff we're used to today.
Right, and it's also worth pointing out Cosmos proof of stake network, what Osmosis is built on top of. There's a really interesting question here. It's got to be from a lawyer, but it's about contract enforcement. So the question is, have there been examples where laws have not upheld property rights of NFTs or other transactions using cryptocurrencies? Now, we don't have any legal experts, but I think there's probably some thoughts on that. I think another like shade of that question is, we use the term smart contract, but are they contracts in the eyes of the law? And, if push came to shove, how would they be enforced? Galia, do you want to take a shot at that one?
Well, I can just say that at least in NFTs, we're in very, very early days. Everything that we're seeing is, very experimental in nature. We're starting now to see, some of the bigger brands, whether it's NBA or others, get into NFTs. Those are usually the folks that have kind of the big IP portfolios, and then thus the big IP needs in terms of rights down the line. But we're really in the first inning there. I don't think there's a ton of clear answers yet on how to sort of protect IP all the way down the chain. And it's why you haven't seen all of the big brands and all of the big, IP catalogs enter in quite yet. Everyone's exploring it, certainly, and some are even floating test balloons. But like you said, Alex, we still have a few components of the stack to piece together to get the full solution. And even things like folks being aware that a digital asset that's owned, let's say I own a particular NFT, you can very easily screenshot it and put it up as your profile, right? Just because you don't own the NFT. And so we're still, like I said, in the early days of figuring out how would you do a cease and desist on someone who's screenshotting your NFT and using it as their profile photo. Usually the answers are going to come from tech and not from law. I mean, law is so far behind anyways, just catching up on these new paradigms. So for example, Twitter announced that they're going to release, tooling that essentially will let users upload their NFTs sort of officially as their profile photo. In that case, you wouldn't be able to upload a screenshot of someone else's NFT. You actually would have to have the actual tokenized NFT yourself in your wallet in order to use that image as your profile photo. So it's just an example of where, a lot of the IP question is going to try and be solved by the tech itself rather than the legal system.
Yeah, that's a brilliant idea that, I think a lot of existing systems, whether it's the legal system or, government institutions, lack the resources and the knowledge base to, contemplate and deal with a lot of the changes that are being brought about by technology. It's 12:55. We have exactly 3 minutes, and then we're going to hand it back. So 1 minute per panelist. One prediction for 5 years from now. Sunny, we'll start with you.
One prediction for 5 years from now. I don't know. I mean, I guess what I'm interested in is we're gonna start to see more innovations come out of the DeFi world. So I think that what we're starting to see is more. Once upon a time, where's all the financial innovation coming from? You go to Goldman Sachs, and that's where all the best minds are working. And I think today, all the best minds and working in finance and a lot of industries, but are in DeFi right now. And so, I think so far things like AMMs. I think there's two big financial innovations that I think are truly crypto native that came from the crypto industry, not elsewhere. It was AMMs and perpetuals. And both of these are amazing. And, obviously, like we mentioned, Bancor is one of the ones that innovated one of them. But I think that 5 years from now, we're just going to see more and more new primitives and innovations coming out of this space that just outshine what comes out of traditional finance.
Okay. Andrew?
Yeah, so I think my prediction is that the total value locked in DeFi will be over $10 trillion. Right now, we're at about $250 billion, which is a 100x increase from 16 months ago. And even before that, it was I remember the days 3 years ago when there's MakerDAO hit $200 million and it was huge. So I think we'll see 40x increase in TVL. So that's kind of a DeFi version of AUM over the next 5 years as more and more of these chains come on board, these liquidity mining programs continue to ramp up, and more of the world becomes tokenized.
Galia?
I think 5 years from now, as many people will have crypto wallets on their phones as have WhatsApp on their phones.
Which would be about 2 billion, I think. Everyone, pretty much, yeah. Some bold predictions from our expert panel. And when people like Galia, Andrew, and Sunny talk, it's always good to listen. And it's been a real pleasure to host this panel. I think we could have gone for hours longer. And if you'd like to hear from both Sunny and Galia, and Andrew more actually, both Sunny and Galia have been guests on DeFi Decoded with me and Andrew, where we dig into more detail on Bancor and Osmosis and their views on the space. So let this be the start of your journey, not the end. Thank you very much. And I'll hand it back to Anita.
Thanks, Alex. Well, guests, thank you for spending your lunch hour with us today. I certainly learned a ton. Thank you, Alex, for your insights and leading the panel in a lively and informative discussion. One of the questions that we were getting most frequently while the panel was going on was, will this be available after? So I think, it's a lot of good information that people want to be able to access. I know that one of our panelists, Sandeep from India, he seems to have gotten disconnected, but Galia, Sunny, and Andrew, thank you so much for joining us and adjusting your time zones and sharing your knowledge. We wish all of you the best in your future efforts, and just thank you for helping our audience understand the potential of this technology. I would like to thank our sponsors again for helping make today's event a success. Thank you to Wealthsimple, and with their sponsorship, today was free for everyone. And thank you to EY, today's event sponsor. And a thank you to our AV supplier, Van Valkenburg Communications and LiveMeeting.ca for making it possible for us to come together virtually today. Guests, we hope you'll join us for some of our upcoming events. Tomorrow, Thursday, November 4th, we turn to financial literacy in celebration of Financial Literacy Month. Our panel of experts will be highlighting some of the newest digital tools that can help us in this integral area of our lives. And then please save the date for an in-person breakfast event on November 17th with the Honorable Minister Fedeli, Ontario's Minister of Finance, where he will add detail to his upcoming fall economic statement. To learn more about our upcoming events, explore our newly designed website at canadianclub.org, browse our rich archive of past events, including this one, and check out our new updated membership categories with enhanced benefits, and please consider becoming a member of the Canadian Club. Thank you for joining us. Please stay healthy and stay safe.